Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for February 18th of 2024. I think we're going to start off this week with a little bit of mention of the Consumer Price Index, CPI inflation data, which came out a little bit hotter than expected. You can see here we've got the CPI month over month, and then we've got the core CPI. And you can see both of those little red bars there are a little bit higher than what we've seen in the last several months. The overall CPI is a little bit more noisy than the core has been, and you can see the general trend line in the core has been coming down. Of course, this took the market by surprise earlier this week, and we had a fairly pronounced sell-off. If you look at the trend line data, we're still tracking pretty well. So when you look at it, the overall inflation on a rolling 3-month basis, both at the all-in CPI and the core level, we are tracking a lot closer to the 2 to 3% range, and I think most people feel generally pretty comfortable about that. The pace of inflation decline is going to take some time. Of course, it threw off some expectations with regard to lowering of interest rates, which I've always been a little bit more circumspect about the pace of interest rate declines, because we're at this interesting juncture where inflation declines are going to be a lot slower to come by now, although I still think the pace is going to decline. I think we're going to have pockets of slowness. We have a little bit of mixed message coming out of manufacturing, but the data at manufacturing, as we'll see in a little bit, looks a little bit better. And overall things are really not that bad. We saw some sluggishness in retail sales, which we're going to look at next after inflation. But, overall, the economy seems to be chugging along kind of at a relatively slow pace. And good news for the economy, good news for consumers to some degree. However, not so good if you're expecting a lot of rate decreases, which would usually be predicated on some more pronounced economic slowness. And so while we still feel like there's going to be rate declines, they're just going to be a little bit delayed in their appearance. And so we just have to be patient as things progress along here in 2024. Look at some subcomponents of the CPI here. We've got goods inflation on the left, and then we've got services on the right. So it's a tale of two different cities here. And clearly services inflation is still pretty well entrenched, but we've known that. You can see those bars over here on this side, have been consistently high, whereas we've seen, quite a few months of relative relief on the good side. And so service inflation is essentially what we're dealing with now. And as you know, and have heard me say, that rents, which we will talk about in a second, and wages remain elevated, and these are the last things to really come down. But I think we've got a disconnect on the rent side. And we're seeing realized rents, which are ultimately going to lead to core CPI declines, in my opinion. And let's talk about shelter for a second. This is a meaningful component of the Consumer Price Index. And when you get down to the core level, it can account for 35 to 40%. So it is rather meaningful, and it's still meaningful in the all-in CPI number. And so you can see here over the last month we were up in January 0.6%. So that represents a clear deviation from this near-term trend here. And so that's shelter. And so technically a different computation, although it sounds very similar. OER, or owner's equivalent rent of primary residence, has been in a downturn, and so we saw an uptick there too, also up 0.6% during the month. But as we see over here in this chart, we've got basically new tenant rent index. So we have net rents that are being observed in the market right now that are actually going down. And maybe here over the next month or so, what we're going to be looking at, and this is leading by a year. So even though it kind of looks awkward that we see 2025, I mean, this is actually pushing forward by a year. And so it's overlaid against the rent of primary residence, which is important for these numbers over here. And as you can see, clearly in these numbers over here, they remain elevated. But if the trend lines follow historical patterns here, that number will roll over. And so observed rents in the marketplace are actually much lower than what's being represented here in the consumer price index. And I think that's an important factor as we look at the pace of inflation going forward and the probability of rate decreases later on this year. So now we'll turn our attention to retail sales, which, as I said, were a little bit soft. We can see that in the data here, long trend line. Then we had a relatively strong performance here coming out of the pandemic, and then that kind of whipsawed basically to get us more to a baseline average of about 4.7% on a year-over-year basis. And you can see the last data point was down about 0.2%. Not too bad, but it was a bit of a surprise. So when you look at higher inflation, higher than expected inflation in those last several charts from the CPI data, and then you also consider retail sales, which I think to a mild degree were impacted by weather, because this is a very near-term data point, and I think we've got to be careful about extrapolating trends out of near-term data where we have had some pretty significant storms. Although I will say that the online retail sales data was not nearly, it was also down a little bit too. So, and that data wouldn't have been impacted by weather. But again, retail sales, something that we're watching very attentively because of, its significance on the overall economy. We're slightly down, but nothing that I would really consider to be terribly alarming. This is just kind of noise in the data, and again, something that we need to watch over a trend line. Here we have a couple of components of retail sales. We've got food and services sales. After several months of pretty strong performance here, we saw that turn slightly negative. Again, I don't consider that to be too catastrophic, although the deviation from expectation was rather significant. Same down here for retail sales outside of automotive and gasoline sales. Those were also down after following a fairly strong trend line here. But I wanted to kind of add this chart in here as well, because we've got U.S. retail sales in the black line, as it were, up here in the black. And you can see that there's a pretty line of nice natural fit here as you go back to 2017. And then with this disruption in the pandemic, we really rocketed higher. And so this last data point represents this little downtick here, which, I think it's, again, it's in a microcosm, we're up significantly over the trend line that had been established previously. If you look at real retail sales, they are a little bit softer because obviously we've had inflation during this time. And so that does weigh, but when you look at overall retail sales, and when you go down here to this control group, which is a more narrow band of items that are being tracked here, then you also see the same phenomenon. And so retail sales, as it were, again, not terribly catastrophic. Now, if you see that this real retail sales line really kind of roll over down here, then we get concerned, but right now it's not too bad. So in this chart from BCA Research, we've been talking a lot about excess savings and as a proxy for the kind of liquidity that consumers still have. And we've been talking about how that's been going down. And then at one point we talked about it, really not being measured correctly, that it was actually being underrepresented. And this, when you think about this kind of implies that, pandemic checks that went out and the savings that people had naturally anyway were going to help sustain this spending through an indefinite period heading into the future. And we know that the supply of money is slowing, but there's still a lot of liquidity in the system. This chart for BCA tends to suggest that it's in the upper income cohort, that in fact that some of the lower income cohorts have exhausted their excess savings. And so the purchasing power really lies in the top 20%. Now we talk about manufacturing production. We know that manufacturing's been in a kind of rolling recession, if you will, but there are some green shoots here. There's actually a lot to talk about in manufacturing, and it probably deserves its own charts of the week at some point. But here clearly we see a lot of noise in the data. And this is month over month, which, as I said, the monthly data can be a little bit choppy, and so it's important to look at it on a trend line. And you can see, here on a production timeline going back to 2016, we were in a bit of a glide path for a while, but we're actually decelerating heading into the pandemic, and then obviously we have this bump and rebound, and then we've just been in this kind of multi quarter decline here, which was represented in the latest data point here. And as a result, we see capacity utilization go down as well, and usually you get more investment spending when you start to bump up to around 80% utilization. That's when people that are manufacturing things need to add more capacity. So we do have some slack capacity now, but and we also see here, when you look at year over year manufacturing output, that we have been in this rolling recession, and we saw this green shoot. Now we took a little step back, and this is manufacturing ex autos. And so, when you tie this number, over here, and you're still in a little bit of a manufacturing funk, I think, when you get down to productivity enhancements and you kind of settle out on demand, this has an opportunity to rectify itself, and obviously you don't want to overproduce at a time where you're unsure of where your inventories need to be in the channel, and so there's a fair amount of hesitancy here, but manufacturing overall is not getting worse. So it's important to note that that there are other things you can look at with regard to manufacturing that actually give you some different signals. And these are two very important areas of the country when you think about the Empire State, which is New York, and the Philadelphia Fed. Again, we've got two East Coast Fed surveys here. And when you look at the Empire State, manufacturing is on its upswing. So again, it's been negative for a while. We had a downtick, and then now we've had an uptick. Also, when we talk about new orders, same deal here. We go over to Philly Fed. We've actually eclipsed the negative, and we're now in the positive as far as manufacturing on the index level. And it was much better than expected, too, as was the case here in New York. But you also have shipments, which are now positive in a solid way, something that we haven't seen for probably a year and a half, basically. And so when we talk about manufacturing being sluggish, while it is true, there are areas of the country that are actually witnessing some strength here that have been rather weak for a while. So when we talk about productivity, another word for that would be operational efficiency to some degree. And so I came across this in Morgan Stanley research, or it was republished in the Daily Shot here. And so corporate transcript, and these are like earnings calls, and we've just had a whole bunch of fourth quarter earnings calls. And so, when we look over time at the mentions of essentially productivity, obviously it took a backseat here, but then we've accelerated here. What that tells me here is that we are setting ourselves up. Factor productivity is increasing. That helps to keep inflation low. And right now we've got the National Federation of Independent Business, their index for jobs hard to find, or excuse me, hard to fill. And so this is advanced, this is in the green line, and it's advanced a couple of years. And so where we are now in a line that has some respectable positive correlation, but it's not entirely perfect, but it would certainly imply that productivity is going to continue to increase, and that these two areas are going to meet at some point. And so, jobs hard to fill is going to kind of, again, settle out at some point, and we'll have a more normalized economy, likely in a new economic cycle at some point. So switching gears here a little bit from Refinitiv, we've got data on business investment. So we looked at capitalization, or excuse me, capital uh, plant utilization earlier, and we saw that that was in decline. But you can see here very clearly, and this is a percent gain quarter over quarter, but it's an annualized number that, IT equipment, we've had a lot of technology spending, and for a lot of different reasons too. Software, we know R&D is a little bit lower because I think companies are protecting their profits a bit, and so that's been a bit sluggish. But then we've seen software spending, which maybe hasn't been as robust as it was a couple of years ago, still is nevertheless positive. So companies are spending and into the cycle, even though they're not adding to capacity necessarily, they're adding to productivity, which, as I said before, helps to keep inflation at bay. On this slide, we have an interesting overlay, and so we look at this. We've got in the green line, we got the U.S. Institute for Supply Manufacturing Index, which we know has been sluggish, and so we look at that line, and we know that it's been sluggish a bit. And then here we have the equity futures from leverage funds and asset managers and their positioning relative to that, and so. Here's another, the data don't lie. And so when you look at this and you see the relationship, although, pandemic aside, that was really kind of a hairball, but actually that was almost pre-pandemic here that we saw that deviation. But outside of that, it's a pretty tight fit. And so we're seeing a rather strong gap right now. And so the feeling is that, we're going to have, again, a meeting of some sort right here. And so we're going to have there's an enthusiasm level that's pretty high right now, which should draw the ISM up. So this data tends to meet somewhere in the middle. Let's talk about the office real estate market right now. Vacancy rates are pretty high. I just had a chance to attend at least our local bankers luncheon. Had a real estate panel, and the thought was that there's going to be several years of absorption of excess real estate, that we've had a really high spike in the amount of sublease space that's hit the market. And here in Central Texas, we're talking about technology firms that I think are trying to play a lot of defense here and getting rid of a lot of space, as they're frankly still trying to figure out, the future of work and the future of office. And so, what's interesting here is that, this number continues to eke up, but it's going back to levels that we saw a handful of years ago. And of course, we had back in the 80s and early 90s. Well, we have the S&L crisis, but it is something that we're watching, and we do know that the smaller banks are the ones that are lending on this. You see smaller banks down here. This is commercial real estate loans to capital ratio, and it tends to be focused in the smaller banks than certainly in the large banks like Wells Fargo, Chase, Bank of America. And you can clearly see here, regional banks in blue, they just tend to hold the majority of these real estate loans. And I still think that we're going to have a little bit of a credit shock. I think office as a percent of the total real estate market, just to be clear, is well in the minority. It's like 10 to 15%. So I wouldn't get too carried away, but it is something that's worth watching as we get into a lot of these maturities that I think the crux of which are going to happen next year. Switching gears on residential real estate, obviously affordability to some degree. I didn't put the mortgage numbers in here, the chart on that, but mortgage rates are moving back up again over 7% because we do have higher 10-year yield. But builder sentiment is really has really improved as of late. We can see that uptick there. And expected single-family sales, moving higher. Again, this is all despite the fact that, that we have a little bit higher prices out there and we have affordability. But I think consumers are adjusting to that new normal of essentially, credit's going to be a little bit tighter and it's going to be a little bit more expensive. but we have traffic here of prospective buyers. This is the National Association of Home Builders, and so that's looking better as well. Talk about small businesses now. So we've got we saw some data from NFIB before, National Federation of Independent Business. And here's the Small Business Optimism Index. And so, this is something that we want to watch. It's been somewhat depressed for some time, and we saw a little bit of a downtick. Clearly, the actual number was below expectations. Again, is this something that we need to be, panicking about? I'd say no. But it just reflects a little bit tighter conditions, even though we know credit to a large degree is kind of easing up a little bit. But, we've got hiring plans. These small businesses are playing defense. They're not going out and hiring a lot of people. And their advertised job openings are going down too. So they're trying to squeeze more juice from the lemon, trying to get more out of existing employees. And we do know from the charts a few slides ago that they're investing in IT. They're investing in things to help make them more productive so that they're not necessarily having to hire new people. And that's why we see a lot of hiring plans and job openings go down at the same time that optimism remains somewhat subdued. So with all that being said, I want to turn our attention to GDP, overall economic growth, and we'll circle back to something we've shown you quite a bit in the past, and that's the Atlanta Fed GDP now. They do a phenomenal job. You've heard me say this before, but they've been relatively accurate. And so, the shaded part right here represents a whole bunch of economists, and then here's your trend line. We do know that optimism is moving up. The current consensus now, the range of top 10 and bottom 10 average forecasts for, again, first quarter of 2024, which, we've been talking about the prospect of having a slower economy, but that doesn't seem to be materializing. And so overall economic growth looking about 1.75%. Well, the Atlanta Fed is coming in a bit higher than that. They're looking at something that's about 2.9% right now. And that's down, but that's still a lot stronger than where the consensus is. And so herein lies the divide, as we head into, February. Of course, this data comes to us at a couple weeks lag or so. And so it'd be interesting to see where the consensus migrates to, but clearly we see the Atlanta Fed kind of gravitating in that 3% range, which obviously would not be indicative of an impending recession, and it probably wouldn't be convincing enough to a Fed to commit to a rate decrease schedule, and that's why these estimates of when that first rate cut is coming, why those estimates are really being pushed out right now. So now we'll turn our attention here to the investment markets, and so we've got a couple of stock-related charts here to show you, and really the takeaway from this is that we do expect to see more performance out of dividend growth, especially if we do have a little bit of a soft patch of, as we saw retail sales slow up a little bit, remain sluggish. Then we've got basically savings that are driving up, which are kind of basically, if we exhibit slower growth, we tend to favor dividend growth because it can be a little bit more stabilizing, tends to reflect companies that have enough financial strength that they pay those dividends. But you can see here, that we've got basically a chart that kind of weighs the equal weighted index of the S&P 500. So this mutes out the impact of those Magnificent Seven stocks, which account for 30% of the index. Again, think about that. 7 stocks out of 500 that account for 30% of the index. That's a huge influence. And the fact that they all happen to be technology means that index on an all-in basis can be very, very volatile. So we condense it down into the equal weight. So every stock in that index has an equal influence. And then we overlay that onto the dividend growth basket as a factor. And we go back over a year, we can see how dividend growth has provided a little bit of outperformance relative to the equal weight. And so, especially if you think that you're going to exhibit a little bit of economic slowness, that would be a factor that you would want to emphasize. And so with stocks having improved from a valuation standpoint, this chart here from Goldman Sachs, you've got a low dividend payout ratio, in their mind points to a scenario where your dividends can actually potentially outgrow earnings. And I do think that there is a possibility of that. And so, if you not just looking at historical performance of those two different data series, but also looking at the fact that history also suggests that when you have low payout ratios, you tend to have a breakout in the relative performance of dividend producing stocks. And so obviously that's something that we think is interesting and a factor which we are looking to exploit now. Well, another factor that I think is worth noting right now is international investing. We've had, in this chart here, we've got basically the MSCI World Index less the U.S., and then you've got, U.S. stocks. And clearly we've seen an outperformance. So the relative performance, as you look down here, has been outstanding. So clearly the right move has been to focus a lot more heavily on the U.S., but as we see, and this has played out for a relatively extended period of time, and you can clearly see, here as well, that outperformance really began to assert itself. We got into the middle part of last year, and so these things do have a way of kind of mean reverting at junctures, and so this would really beg, this kind of relative outperformance is something that would really beg more allocation into international investments. Well, we talked about the Mag 7 a couple slides ago, and this is just some empirical data coming out of CompuStat and S&P regarding the top 10 stocks versus the S&P 500. And so I think it really speaks pretty heavily to the bandwagon theory. You hear a lot about the Magnificent Seven stocks, and it inspires a lot of investors that are trying to chase the caboose on the train pulling out of the station to go jump in headlong into these stocks. And that can work for a while, but what this empirical research tells us is that in all but really one case here, that when you jump into the top largest stocks in the S&P, that the year following that ranking, you tend to see underperformance because, as you might imagine, there's a reason for that outperformance. The multiples are going up and earnings are going up, but you bump into the law of large numbers, and then you get to a point where really the only way on valuation is down, and the only direction, or one of two directions you can go in earnings, is either flattening out or kind of reversing. And I think that's what happens when you look at this. So it's important not to go look in the rearview mirror and have regret and jump in with 2 feet into areas of the market which have done well, because history tells us very clearly that oftentimes that situation reverses. Quick look here at the Treasury spread. We did see 2-year yields really spike when it became apparent that the Fed is not likely to to lower rates until at least mid-year. And so that changed quite a bit. But on this chart, we're clearly just looking at the U.S. 10-year Treasury less the yield on the 3-month Treasury. The Fed spends a lot of time looking at this, and so as a result, so do we. But we have been inverted for a really long time. You can see here from this chart from Charlie Bolello, 473 days. And you look back here, I mean, we haven't seen this kind of a duration of a inverted yield curve for a heck of a long time, and it's still quite inverted, all things considered. And so again, you've seen these periods in the past, and you almost always see a recession, but this is kind of an odd time because we're still dealing with aftershocks of the pandemic. But I'm just identifying the fact that yield curve is still quite inverted. Then here on our last slide, something I thought was pretty interesting. A lot of rhetoric on budgets and kind of kicking the can down the road and maybe getting another continuing resolution until we get to the end of the current fiscal year, which will end at the end of September. Who knows? It's hard to predict what goes on in Congress, but a lot of I guess, the jawboning on this is, aid to Israel and aid to Ukraine, et cetera. And what was interesting in reading a journal in the Wall Street Journal last week was that, with these tensions globally, and particularly in Ukraine, you've got a lot of European buyers of U.S. armament. And so, interestingly enough, you've got this foreign direct investment that is really spiked, certainly relative to China. China's in the red. That's going the other way because people are shunning China, but they're buying from the U.S. And so when you look at the difference between 2021 and 2023, you can see defense and space equipment really going higher. So defending Ukraine, even though it stretches our budget, it is a net positive in the sense that we're selling a lot of stuff to other people. Hope you've enjoyed that. That's all I've got this week. Have a great week, and we'll talk to you again soon.